What if I told you that most Canadians are working twice as hard for the same dollar just because their wealth isn't structured right? You might be earning well, investing wisely, and still losing a third of what you build to taxes, probate, and poor timing. It happens quietly, especially now with shifting tax brackets, contribution limits, and clawback thresholds. The truth, you can't out-invest a 30, 40, or even 53% tax rate. You can only design around it. In this video, I'll show you why the biggest opportunity in wealth planning isn't what your investments earn, it's what you keep. We'll look at how smart structure, timing, and ownership design can preserve 30 to 40% more of your family's wealth, often with less risk than changing your portfolio. Whether you're 5 years from retirement or already living off your savings, these are the quiet strategies that set lasting wealth apart from temporary gains. If you're new here, welcome. I'm Jacqueline Ozdemir, a financial advisor with Ferguson Financial Planning. I work with Canadians who've built a solid foundation, but want to make sure they're actually keeping more of what they've earned. Over the years, I've seen countless people doing all the right things, investing, saving, planning, but still losing ground because their wealth structure leaks value through taxes, probate, and timing. And honestly, it's not about working harder, it's about working smarter with what you already have. So, in today's video, we're going to break down how smart design, not market-chasing returns, drives real financial progress. I'll walk you through why you can't out-invest avoidable taxes, the biggest leaks that quietly drain wealth, how to start planning around what you actually keep, what 2026 rule changes mean for your strategy, and 4 planning plays that often beat trying to outguess the markets. If you find this video helpful, please hit like, leave a comment, and subscribe so you don't miss future episodes. All right, let's get into it. Let's start with something most people never hear from their financial advisor. You can't out-invest avoidable taxes. And yet, that's where most of the energy goes. We obsess over performance, growth charts, and the next big market move. But if your wealth plan leaks taxes, probate fees, or avoidable costs, it's like trying to fill a bathtub with the drain open. The real lift, the wealth that lasts, comes not from what your portfolio earns, but from how your overall design keeps it. Let's run a quick mental experiment. Say you have $5 million invested. If you chase an extra 1% return, you might make $50,000 before tax, and you hope the market cooperates. But say you're selling your business and use a tool that's right there in the rulebook, the lifetime capital gains exemption. Under 2026 rules, that exemption shields up to $1,250,000 of capital gains from tax. Since capital gains are only half taxable and the top combined marginal tax rate in Ontario is 53.53%, that's around $625,000 of taxable income avoided. Multiply that by your marginal tax rate, and you've just saved roughly $334,000 in one go. That's not a lucky market year. That's smart structure. Think about it this way. If your portfolio manager offered you a 6.7% after-tax excess return every single year, you'd probably think, what's the catch? But here the catch is just planning. That's why strategy beats speculation. The same logic applies to everyday choices. How you title accounts, how you structure dividends, whether cash flow comes from TFSAs, RSPs, or non-registered accounts. A dollar saved in tax is not subject to market volatility. It's a risk-free yield. And with Ontario's top rate touching 53.53%, those tax decisions can outweigh several years of aggressive performance. The idea isn't that investments don't matter, they do. It's that they're the sideshow sometimes. The main event is the full design. Ownership, timing, and cash flow decisions that coordinate together like gears of a watch. When those are synchronized, you capture more compounding across the same wealth base. It's quieter, but it's real wealth building. And it's why I always say you don't get rich on gross, you get rich on net. Now that we've reframed what actually drives wealth, let's look at where it leaks away. There are 3 main culprits: poorly timed gains, probate exposure, and tax-inefficient income years. They're simple on the surface, but they quietly erode 6 figures at a time. Let's start with timing. Taxes are incredibly sensitive to when. Triggering a capital gain in December instead of January could make a huge difference in the taxes you pay if you have a significant increase in your income from one year to the next, or lock in RRSP income too early, and your marginal tax rate may take an unexpected jump. Here's a tax mistake I see far more often than people realize. Imagine you sell an investment in January and trigger a capital gain. On its own, that might seem harmless. After all, capital gains are only half taxable. But here's what many people miss. Taxes don't look at events in isolation. They look at your total income for the calendar year. Now, let's say that in February, you receive a large bonus from work or exercise some of your employee stock options. Suddenly, that capital gain you triggered in January is being stacked on top of your highest income year. That pushes you into a higher marginal tax bracket, which means a larger portion of that capital gain is now taxed at potentially the top rate. If instead you had triggered that same capital gain in December of the previous year, it would have been reported in a lower income year before that bonus or exercising your stock options even existed. Same investment, same gain, completely different tax result. One decision was made in January, the tax bill didn't show up until April. This is why smart tax planning isn't just about what you earn, it's about when income shows up on your tax return. The second big leak is probate. In Ontario, the estate administration tax is 1.5% of assets over $50,000. It doesn't sound like much until you add zeros. A client once came in with a plan where about $5.5 million would pass through their estate. That meant roughly $81,750 in probate. Simply shifting certain assets under a secondary will and adjusting beneficiary designations brought the taxable base down to about $1.5 million. The probate bill dropped to $21,750, saving roughly $60,000 and, more importantly, less paperwork, fewer delays, and less stress for their family. You could spend a year trying to earn an extra 1.2% from your investments to match that. Or you could fix the paperwork once and have it pay off forever. The third leak is what I call income year mismatch. Many people hit retirement or business sale years where cash flows stack on top of each other. RSP withdrawals, dividends, capital gains, maybe CPP and OAS, that can push income well into higher brackets or even trigger the OAS clawback, which begins at $93,454 of income in 2026. Once you're over that line, 15 cents of every dollar above it gets clawed back. So controlling when and where you draw from, even shifting $10,000 from taxable income to maybe TFSA withdrawals, can save $1,500 in OAS every year, not even counting the ripple effect on your tax rate. The point is this: the big money is hidden in coordination. A plan that controls timing, avoids unnecessary estate exposure, and balances income across years does more for your net worth than any hot stock tip. It's not glamorous, but it's smart. When most people meet an advisor, the opening question is, how are your investments doing? But that's not always the right place to start. A real wealth conversation should sound more like, what happens to your accounts if something happens to you tomorrow? Or how much does the CRA get if we don't rearrange a few things? It's not about selling a product, it's about mapping the flow. Here's what that first meeting should feel like. We sit together and look at your accounts, not just the numbers, but how they actually connect. Registered ones, non-registered, corporate, even real estate, everything. We trace where it all goes if tomorrow you weren't around. We see what's exposed to tax, what passes through the estate, and what transfers directly to heirs or spouses. It's like drawing your financial GPS. You need to know the starting point before rerouting. From there, we quantify each leak. Maybe the lifetime capital gains exemption saves you $300,000 on a business sale. Maybe creating a secondary will for your corporation will save $60,000 in probate. Maybe rethinking your drawdown sequence keeps both you and your spouse below the OAS clawback band, preserving $3,000 a year. Added together, those are big results for simple shifts. And that's before a single investment change. It also sets the tone for a partnership built on clarity rather than sales. When people understand that they might find hundreds of thousands of dollars simply through restructuring their affairs, they start thinking differently. They stop asking, what mutual fund is best? And start asking, how do I make this portfolio tax efficient across my lifetime? It changes the conversation. You can test this mindset yourself. Ask, if my net worth was distributed tonight, what percentage would actually reach my family? For many, the answer sits around 60 to 70%. The rest gets lost to taxes, clawbacks, delays, or simple inefficiency. Coordinated planning can push that number dramatically higher, sometimes preserving 30 to 40% more across a generation. That's the payoff for leading with what you keep. Let's talk about why this conversation matters right now. 2026 brings a handful of quietly powerful updates that change how the math works for Canadians. The TFSA contribution limit for this year is $7,000. If you've been eligible to contribute since 2009, your total contribution room sits at $109,000 by now, tax-free forever. That space you can use for income smoothing, especially if you draw TFSA funds instead of taxable ones during high-income years to dodge clawbacks. No market strategy can offer that clean of a win. Your RRSP contribution limit for 2026 is $33,810 or 18% of income, whichever is lower. That's your top deduction zone. But the real play starts when you coordinate RRSP and RIF withdrawals over time. Start modest withdrawals in your 60s, pair them with TFSA reinvestment, and you lower forced income later when OAS clawback bites harder. It's a design move, not a gamble. Then there's the OAS threshold, $93,454 for this year. It resets each January, and once you go over 15 cents on every extra dollar, disappears until OAS is fully clawed back around $151,000 to $157,000, depending on age. Knowing that lets you time income flows with surgical precision. And perhaps the biggest gift for business owners, the capital gains inclusion rate stays at 1/2 for now, and the lifetime capital gains exemption remains at $1,250,000 for qualifying small business shares or qualified farm or fishing property. The proposed capital gain inclusion hike was scrapped in early 2025, which means planning opportunities are still wide open. If you're weighing a sale, that one decision move could save you hundreds of thousands under the current structure. Lastly, the alternative minimum tax, AMT rules that kicked in during 2024 now fully apply. The rate is 20.5% with roughly $181,000 of exemption. If you're donating securities, realizing large gains, or triggering deductions in 1 year, AMT can hit at unexpected times. Awareness here avoids messy surprises. And again, you can adjust timing to balance the outcome. All these rule tweaks may sound technical, but together they reshape what smart looks like for 2026. If you coordinate your structure properly, you're taking free money the system already offers. Ignore it, and you're leaving it on the table. Now, let's pull everything together with 4 plays that, in my experience, usually outperform chasing returns year after year. First, create what I call a probate light estate map. That means clear beneficiary designations on registered accounts and insurance, secondary wills if you own private company shares, and joint ownership where appropriate. It's about routing. In one Ontario example, cutting estate exposure from $5.5 million to $1.5 million reduced probate by roughly $60,000. That's pure value created from design. Second, control your drawdown sequence. Think of retirement income like a mix of faucets: RRSPs, TFSAs, non-registered investments, maybe corporate retained earnings. Turn them on in the right order and you stay in lower brackets and preserve OAS. Turn the wrong one and your total lifetime tax can jump. A couple in their mid-60s drawing early from RRSPs instead of deferring to age 70 can fill their lower brackets now and potentially protect themselves from bracket creep later. It's a timing dance, but one that pays off every year. Third, plan capital gains smartly. Use your exclusion rates while they're favorable and take advantage of the lifetime capital gains exemption if you own qualified small business corporation shares. In our example earlier, a one-time election to use the lifetime capital gains exemption on a $3.5 million gain saved roughly $334,000 in tax. You might chase market performance for a decade to achieve that same net impact. And fourth, think ahead about corporate surpluses and estate liquidity. If you hold a company, it's not the value that's risky, it's the tax on the deemed disposition at death. At 26.76% on capital gains in the top bracket, ignoring that tax is like pretending gravity doesn't exist. You can plan around it through insurance, pipelines, or share reorganizations, but only if you know the liability. We don't plan for death out of superstition, we plan because the CRA doesn't offer extensions of sympathy. These 4 plays alone, ownership structure, income sequencing, gain management, and estate liquidity, can preserve hundreds of thousands, sometimes more. And none of them require you to predict the market. They just require knowing where your money sits, where it will flow, and who gets it next. It's funny. People often think advanced wealth planning means complexity. In truth, it's the opposite. It's simplifying the system so every dollar has a job and every tax rule is working for you, not against you. Take the time once, set the flow right, and it quietly compounds year after year. So if there's one idea to leave you with, it's this. Wealth isn't earned only by performance. It's kept by design. You don't have to outsmart the market. You just have to stop donating avoidable taxes. That's real financial progress. And it's available to anyone willing to look under the hood. So let's bring this full circle. What we've talked about today isn't about chasing the next hot stock or trying to beat the market. It's about designing your wealth so more of it stays with you and less quietly slips away. The lesson: strategy always beats speculation. By tightening the leaks, timing your income smartly, reducing probate exposure, and coordinating accounts, you're not just saving a few $1,000s here and there. You're preserving hundreds of thousands over a lifetime, sometimes without changing a single investment. Here's what that means in real life. The couple who planned their RSP withdrawals early now pays less tax every year and keeps their OAS intact. The business owner who used the lifetime capital gains exemption banked an extra few $100,000 on a sale. The family who built a probate light estate saved months of delay and left more to their kids. Wealth ultimately isn't measured in choices. Every design decision, big or small, either builds your legacy or funds someone else's. So as you look at your financial plan, ask yourself, am I focused on what I earn or what I actually keep?